And 3, 2, 1.
All right. Welcome to June. Man, nice out there today, too.
I know.
Yeah.
A little motorcycle riding.
Yeah, I need that. After this week, especially. It seems like it's that every week. There's always something.
Always something. We've gotten to the point where we're like, man, it's week. And it's like, that's kind of redundant.
Yeah.
We're always saying
It's
that.
always something.
Yeah. That's something great about the market, though, is there's always something to talk about.
That is
If
true.
we didn't have anything to talk about, the show would be really boring.
Right?
You
Right.
know?
Yeah.
We'd get on the show and be like, yeah, the market was steady today. See ya.
Fortunately, it was steady so far today. As we're recording here on Friday morning. It's about 10 o'clock in the morning, so that's good. Hopefully it doesn't get too crazy in the afternoon. It looks like we're going to get some support at the 20-day moving average line. And we've had this little correction over the past few days, and it's either a buy the dip opportunity or the market's going to go break through and go lower from here. So we always like to see support at the 20-day moving average line, and so far we're getting it, so that's good.
Everybody likes a little support.
Everybody needs a little support sometimes. All right. So this week it gets a little wonky, so bear with me. But I got some pretty good stuff in here. Yield is the most important thing that's going on right now. The bond market is way more important than the stock market right now. I know for our purposes, we only really care about the CNS funds, really, for most people. But the F fund, yield and the F fund are getting ready to be super important. My favorite indicator is relative strength index, which is this one. And when it gets extremely overbought, you really want to pay attention to it. So we're going to take a look at a chart of the C fund with that. Bonus chart is CRM, Salesforce. So among the other things that happened this week, I'm going to stay away from the one big one that everybody's talking about. But among the other things that happened this week.
Yeah, let's not go there.
Yeah. That was almost going to be a bonus chart.
No, God,
no. Let me just, futures, because the verdict comes out at 4:30 in the afternoon, so the market's closed. DJT is his media group, right? It tanks. Almost 14, 15%, something like that. By the time the market opens, it's all the way back up to whatever the high was from the day before.
You could expect
that.
It
was hysterical. But CRM is much more important.
Which is Salesforce.
Salesforce,
by the way.
Yeah.
Very interesting to me. We really never I don't remember coming in contact too much with it when we were in the Gov. Yeah. It just, particularly, I guess our agency hadn't kind of gotten into it, but it's everywhere in the government. And I went to D.C. government for a couple of years after I retired, and was running one of the smaller agencies or whatever, and I found out that like everything we had was running off Salesforce, and I was like, how did I miss this?
Right.
Because I'm a techie guy, right? So I kind of and then I really dove into it, and I was like, oh my gosh, this thing is incredible. And between ServiceNow and Salesforce, they're kind of competing products. They do something a little different, but like half the government, if not more, is running some version of that. And you're like, well, that's isn't going away. It's kind of like, when it comes to Microsoft and the government has been one of the biggest consumers of Microsoft products for decades, right?
Yep. You know what else? A lot of talk this week I thought was really interesting is they were talking about Dell, and it tanked yesterday, which I was kind of surprised about. But all the talk is about AI integrated PCs,
right?
And Dell is so now obviously NVIDIA is still the kind of the big dog on the block and all that, but NVIDIA is like the Cisco of the internet, right?
Right. They're not necessarily like the Windows PC or Mac, right? They're not that type of hardware. It's a different piece of hardware. Everybody's got a place. That's the thing that a lot of people kind of forget. If you're going macro on this, you're going kind of fundamental analysis, if you will. Microsoft is another kind. Jerry and I talk a lot, obviously, about this stuff, and not all the time we get into it on the show because it's not relevant to the TSP. Right. But I always tell him, like I was kind of in the early days of the internet as part owner of a internet service provider, right? Back in the days when it was all dial-up, right? And so we were working with these companies down in Jackson, Mississippi, which happened to be WorldCom. I'm making this a longer than it needs to be, but I want to give a little context. I remember looking around and seeing companies like not NVIDIA, I'm sorry, but anyway, point is certain companies, right? And seeing like there's no way they're going away because they're such a vital piece to this whole internet thing. And then you fast forward to if you were paying attention to Amazon when they came out, everybody thinks they're a real bookstore, right? And that's not really what they were working on. They were working on AWS, which became the cloud for everyone. And Microsoft was like 5 or 6 years behind them, and they'll never catch them. Like, Bezos and Gates have both said that like there's no possibility of catching them. They can own their piece. But so why do I say all that? If you're watching Microsoft right now, you'll see that they've made a massive investment in OpenAI, which is the company that does ChatGPT. Like, potentially, they could be the next AWS version of AI, meaning it might not be Microsoft itself, but they're such an integrated part of this AI piece that they're smart people, obviously. It's Microsoft. So that would be something to watch when you're looking at some long-term, if you're thinking Buffett type stuff where you're trying to buy Coke at the right time, or you're trying to buy Microsoft is one of those companies when it comes to AI you want to keep an eye on because they're really deeply integrated.
So my sort of long-term thoughts about all this, we talked about this kind of idea quite a few times. The market tanks in, I can't remember, I guess it was 2000, because we're talking about tech companies, so it was probably more about 2000. But Amazon, Microsoft, Apple, all of them, they all were down 70, 80%. But if you thought that pet.com was going to come back and you bought that at the bottom, you were bankrupt.
Right.
If you bought Amazon at the bottom or Microsoft or Apple, right?
Yeah.
So I think there's going to be a significant downturn in the relatively near future.
Yeah, and that's not just Jerry saying that, by the way. I mean, that is a lot of people. And I think the probability of that happening, we talk about possibilities and probabilities all the time. There's always a possibility, right? The difference is there's a high probability this is happening. Doesn't mean it's going to happen. It's just a high probability, right? And so if you knew there was a high probability that you were going to win the lottery, you'd play the lottery. There isn't a high probability, right? It's a low probability.
That's why I don't play the lottery.
Exactly. But if you thought you had a high probability, so back to investing and not the lottery, if you thought you had a high probability because you're watching the fundamentals of companies like Microsoft and Amazon, although everybody knows they're already great companies, but will they be great 10 years from now? What are they investing in? What are they doing, right? Is Amazon too busy putting spaceships in the orbit and they're taking their eye off, AI? I don't know. I'm just putting that out as an example. But the point here is, like Jerry's saying, if you're following this stuff and you see this opportunity, probably don't buy pet.com. You probably want to invest in something that you see, right now it's a value, right?
So what I'm saying is, it's not a value right now.
I mean, I was saying if it took a dive, it's a massive value, which right now it's not. That would be a growth
NVIDIA
company.
is a joke.
You buy that as a growth company, right? You'd say, I want to hold that for the next 30 years. But man, if you knew it was going to stay a growth company and all of a sudden everything tanked, not just everything tanked.
That's right.
Bam, you come in there and you're going to be a happy person. Because if worst case scenario, it makes its way back to where it is and you got all those gains. Yeah. But a lot of people get scared, as they should, right? Because you just lost a lot of money.
80-90%.
Make sure you're not in it on the way down.
Yeah, right.
If you're following us, you won't be.
Yeah.
You won't be in it on the way. We're getting sidetracked.
We're getting very sidetracked, yeah.
But you asked me to pipe in, man. And I know. Pipe it in.
Pipe in when we get to yield.
All right.
All right. So yield. We're gonna talk about yield. This is the 10-year Treasury yield. Okay. It's unbelievably important for a whole bunch of things. For most people, probably the most important thing is mortgage rates. The Fed controls the short end of the yield curve, so 2-year yield and less. Okay. So what the Fed does when it changes interest rates, it's just changing the amount that banks, the yield that banks pay each other on the overnight borrowing. So that's the core of the whole thing, but that's all that the Fed actually mechanically does. And then all the other rates the short end moves along.
They all kind of fall in line in doing what they do, right? That drives the train.
Yeah. Right. Anything 10 years and higher is affected by what the Fed does, but it's much more about what the bond market in general wants to do, right? So that's why you can see bonds yields the 10-year can go up, which it has, even though the Fed is holding rates steady, right? Because the bond market doesn't do what the Fed does. It's a piece of it, right? So this is bond yields peaked in 1981, 82, something like that, at 16%. So when yield is high, the price of bonds is low. Okay, so this was the low in bonds, and if the F fund existed back then, it would be the low in the F fund. Okay, so from 1982 to 2022 is 40 years. So now we're past 40 years of declining interest rates. Okay, so if rates are going down, bonds are going up. So the F fund has been in a 40-year bull market until 2022. At 2022, the 10-year was like 0.5%. It can't go much lower, right? It can go negative. There was times some countries, the U.S. didn't get there, but there were some countries that had negative interest rates. But if you assume that 0 is the floor, so 0.5%, it's not going any lower, right? That means bonds are at a top, and they can't really go any higher because interest rates are almost at 0. So it was pretty easy it's easy to see that rates are only going up from here. They're not going down from here, from this point, right? And that's where they started going up, right? The Fed started raising rates, but bonds had the 10-year had already started going higher before the Fed started raising rates because it can't go any lower. So this is a top, a long-term top, right? 40-something year top in the F fund, right? So if we zoom in, all we're looking at now is this part right here, okay?
You say a top. I know most people are looking at it and going, "That's a bottom."
It's a bottom in yield,
right,
equals a top in price of the.
This is not a chart of the F fund.
No, it's not, because the F fund didn't go back that far.
I know. I'm just pointing that out in case it slipped by.
Yeah.
Like, because you said this is a top as you go down, and you're like, what am I missing?
Right. So this is the most important thing to understand about bonds. When yield goes up, the price of the bond goes down. Okay. So let's say you take, I was talking to my daughter about this. So my daughter, I'm going to sidetrack. So she just gets in the Navy. She's got a starter loan, the ability to take a starter loan, right? 2.99% fixed APR. So she asked me if she should take the loan at low rates, which that's really low, and invest the money, right? So we kind of talked through it a little bit, and I'm like, if you take the loan, so you have a 3%, you owe 3%, you have to invest and make more than that 3%. Or you find something that has a 3% or a dividend or a yield that's higher than that 3%. So right now, 10-year treasury is like 4.5%. So she could buy a 10-year treasury, get 4.5%, pay the 3% back, and keep that 1.5% as a dividend, right? And then
with like absolutely no risk,
zero risk.
That's the key. If anybody's missing that,
not zero, but
pretty darn close.
Pretty close to zero.
Pretty darn close.
So so if she buys a 10-year treasury bond with that, pays the 3%, she keeps the 1.5% difference. After 10 years, she gets her money back, right? If the yield goes down, so you're like, well, if the yield goes down, then she might not cover her 3%. Yes, but if the yield goes down, the price of the bond goes up. So if it's let's say it's at 5%, and the yield goes down to 2.5%, right? Essentially, the value of the bond doubled. The price of the bond doubled.
So her money back will be a lot. So there's two pieces
to
it.
Nope. So if she goes to the 10-year termination time of the bond, she only gets back what she put in. If at 9 years, whatever, or even 2 years, whatever it is, if yield drops from 5% to 2.5%, the value of the bond doubled. So say she takes a $10,000 loan, that the bond what she bought for $10,000 is now worth $20,000. So she just sells the bond.
That's what I meant. I didn't mean waiting to maturation.
Right.
I meant you sell it.
Sell the bond. Yeah,
because you'll walk away with more than you would have gotten at the end of it.
Right. And if rates go up, the price of the bond goes down. So rather than sell it, because then she would take a loss, she just waits the 10 years. Yeah. But if rates are going up, the price of the bond is going down. Rates are going up, it means Say it goes up to.
These are things I wish I'd known when I got my starter loans
Yeah.
back in the day.
Oh,
right?
I bought a Jeep with mine. It was stupid.
I'll give you one stupider. Or I bought a wedding ring.
Stop.
Or a diamond.
Dude, stop.
I'm
Cannot go
sorry.
down that rabbit hole.
I know she's not watching this show, so it's okay.
Oh, boy.
Yeah, I bought a big diamond. Let's move on. Let's talk about bad investments.
Oh, boy. Okay. All right. So we're only looking at this piece right here. Okay. So here's the thing. In the long term of things, what a lot of people are talking about right now is the worry that we've had this 40-year decline. So now we're in some kind of long-term rise, right? So what that means is if we're in some kind of long-term move up, rates are going to go much higher from here over time. Okay. So we're just talking about this piece since 2020 when rates get at a bottom, right there at 0.5%. So since then, it's a weekly chart of the 10-year yield, right? So it's not price, it's yield. So as yield goes up, price goes down. So the yield has gone up, right, since 2020. So the F fund has gone down since 2020. Okay. So yield has gone up in this 1, 2, 3, 4, 5. And we're saying that that's for a 1. Okay, because 1, 2, 3, 4, 5, we should get some kind of correction, ABC, and then 1, 2, 3, 4, 5 for a 3. So that's why this is the 1, this is going to be the 2, this will be the 3. In the long scheme of things, yield should be going much higher over time. But for our purposes for right now, we started at a low, we did this 5-wave Elliott to a top for a 1. We should get some kind of A, B, C correction. Okay. So if this is correct, right, if this Elliott wave count is correct, we had the A wave down, we had the corrective B wave, and now we're looking for a C wave. So we're in the relatively short term, we're saying rates should come down, right? Say they come down to like 3.5%. I would argue that if they do get down to like 3.5%, that's probably the lowest rate we're going to see in our lifetime, because then they start going higher. They could come all the way down. They just can't get, if this Elliott wave count is correct, they just can't get below the 1. So it's possible we could get some kind of, move down like this, and then a bottom, and it can keep going higher. And that would be great, because rates would come way down. I shouldn't say it would be great. It would probably mean we're having some kind of depression, but we could get rates much lower. But if they get to 3.5%, that's what if A and C are the same length, that's where we should get to, roughly 3.5%. So if we got to 3.5% over the next several months, that's probably as low as rates are going to go for a while. Okay. Critically important, yield. So if we think that all that was correct, right? This was the top at 5%, which we had last summer, right? We had the first move down. The correction was an ABC correction, where this length was the same length as this, and we got up to that 786 retracement level, right to it. Okay, and then rates pulled back, which is what we want. So everything looks good. We got a pullback, and then rates started moving higher again, and I didn't do it, but this, from here to here, right, this move is that 78% retracement. If you use the Fibonacci tool and did the same thing from here to here, this move is a 78% retracement of that. Okay, so the Fibonacci's, once one of them kind of gets established, they tend to stay that way. The pattern keeps going. So this is as of yesterday. As of today, we're actually down to 4.5%. Yield is dropping right now. So it's going exactly as we would expect for yield to continue down, okay? Which means the F fund goes up. So the question mark is this, right? If you take away the Fibonacci tool and you draw a trend line, we're still in an uptrend in yield. So even though we're the expectation is that this is A to the length of this line is the same as the length of this line. That's good. It hit our 78% retracement level. That's good. So this is going to be going down like this. It's not confirmed until this trend line gets broken. Okay, and right now it's got a whole bunch of support at that trend line. So we don't want to see price get above 4.7 because that just confirms the uptrend. But when it starts pulling back, we need to see it get below that trend line, and then that confirms a buy for the F fund. Okay, so I'm going to do the F fund itself so you can kind of see it. So that was yield, right? And so now we're talking about the actual price of the F fund. And like Conan said, the F fund didn't exist back in 1982, right? It started here at the dinosaur at the end of 2003. So if you had bought the F fund, if you're like a 60-40 portfolio person, and when the F fund was first introduced in TSP, you're negative, right? So this collapse has been a 100-year historic collapse in bonds. So you would have been, if you had been investing 40% all the way along since 2004, you're underwater. But the chances are we're going to get some move back to the upside. All right. So that's kind of the long-term view. This is this part right here. Okay. So this is the price of the F fund, and it should look inverse to yield because price goes inverse to yield. So we had a top, right, in 2020. That was the top of the F fund for probably a long time because it was the bottom yield, right? So we came down 1, 2, 3, 4, 5. Right? It's the opposite of yield. So we're at this bottom. We got a 1, 2, and so it's either a 1 or an A, a 2 or a B, and the next move higher is either the beginning of a wave 3, which would go higher, or it's a C. So if this is A, B, C, the F fund should come up somewhere around 104, which is a pretty good move to the upside for the F fund, right? If it happens while stocks are collapsing, it's great because we get some kind of positive move in the F fund, better than you would get rate of return in the G fund, and stocks are collapsing. That's why the F fund is so important for us in TSP right now. If the possibility / probability of the stocks collapsing at some point, that's why this is so important right now. And you could also look at it like an upside down head and shoulders. So there's the neckline right there. As soon as we get above the neckline, it's very likely it keeps going. Okay. And if you really want to get kind of wonky about it, this is the kind of a zoomed in, right? So this is the bottom. That was the first move higher. I did the Fibonacci tool. This correction came down to just above that 0.618, okay? But it's the 786 that's been the primary retracement level that we were looking at, in the past couple of charts. So if price keeps coming down because yield keeps going up, price comes down to that 786 level, we get somewhere inside this box. That's probably as low as the F fund should get to before it starts turning back up. If the F fund gets below this low, then the whole Elliott wave count is wrong. So the value of all this is, like, we don't want to buy the F fund until it gets above this downsloping trend line. It could double bottom here at 0.618. It could come all the way down to 786. We're watching it, right? Whatever it does in here. We're expecting it, if it keeps going down, to get no lower than here. If it does keep going down from there, it puts in a double bottom. If it breaks below here, below 91, the whole Elliott wave count is wrong. If the Elliott wave count is wrong, then this just keeps going. Okay, it just means yield is just continuing to go higher. We're not going to get this pullback that we're expecting. All right, I know I'm getting super deep in the weeds, so that is it. So basically, F fund really, really important right now because it's going to be the best alternative for some amount of time if and when the stocks collapse.
Right. When was the last? I always forget this. It's 2018 or 2008. When was the last time we really took advantage of the F fund?
18.
18, I thought. Yeah. It sucks when you have like a 30-some year career. You forget decades. 2018. I'm not sure if that's on our website. I don't recall how far back goes now, but yeah, I mean, we took advantage of the F fund back in 2018. I had already retired, but the reason I'm bringing up is there are definitely points at which, and there are people I'm sure that listen to this going, "Oh, you're freaking nuts!
Yep.
Why would you go in the F fund
Yep.
when it's the only thing performing, and if it's outperforming the G?
Right.
Why wouldn't you use it as an option?"
All of these are tools, and
That's
actually, at the end of this,
You can't be married to a certain fund just because you think it's supposed to do something.
Right.
Right.
They're all tools. They all work in certain markets, and if you can identify which one is going to outperform the other, you win.
Yeah, absolutely.
All right, we're going to talk some more about that actually at the end. Extreme overbought. So relative strength is definitely my favorite indicator. You can just Google it and hit the link from Investopedia, but it's a momentum indicator that we use in technical analysis. Okay, so what it does is it measures the speed and magnitude of price change. Okay, so it's a little bit of a misnomer. A lot of people say when you're looking at a relative chart, it means you're, and we use it too, if you're looking at the relative price between, Salesforce versus the S&P 500. So you want to see if Salesforce is outperforming the S&P 500, you would do CRM divided by SPX, and that chart would give you the relative chart. This is not that. The relative strength indicator, or relative strength index, is giving you the speed and magnitude of a price change. So this is a weekly chart of the S&P 500, the C fund, and this is the relative strength indicator. Okay, the purple line is the actual measurement. The orange line is the moving average of the relative strength. Okay, so it's measuring the essentially momentum. Okay, so when the speed of the change in price starts to decrease, the momentum of the price move is decreasing. So even though the price here is moving higher, the momentum behind that price move is moving lower. Okay, so it's telling us that even though price is continuing up, the momentum behind it is waning. And so then you get price rolls over. And it's the same thing going the other way. When price is coming down and you have a low in relative strength, even though price gets lower here, you have a higher relative strength. It's telling you that momentum is starting to shift the other way. Okay, it's absolutely one of my top 3 indicators. Right now, the reason I kind of pointed this out, if you get above, this is the 70 line, the 50 line, and the 30 line. If you get above 70, particularly in this case, we're way above 70, it's momentum is at extremes to the upside, right? And that was this top right here. So you can get overbought. You can get to extremes in momentum and stay there for a long time, and price can keep moving higher. But once it starts breaking down, especially from really, really overbought levels, it's a problem, okay? And in this case where we're at new highs in price, but we are at significantly lower highs in relative strength. And that's on a weekly basis. So the momentum of this move is weakening. It doesn't mean it can't turn back around and momentum starts doing like this and it stays high, but it's a big red flag right now. Okay. So relative strength, critically important. Okay. Salesforce. So Salesforce, like we talked about, it's one of the biggest, most important companies going. It's not going anywhere. It's just that if you're in it, you don't want to take these giant drawdowns. So here we're going back to 2020. Again, it's a weekly chart. Had a big move after COVID, right? And it peaked like all the other tech companies did in late 2021. And then this was the bear market in 2022, right? Big decline you definitely didn't want to take. But then it bottomed in December 23, like the NASDAQ did and everything else. And now we have this ABC corrective pattern. And we're at a double top. This, if you were watching Salesforce, this was definitely a time. I don't have the relative strength indicator up here now. I wish I did, because it would be interesting to see if relative strength was waning as we were starting to get this double top. Either way, obviously Salesforce rolls over. So how do we avoid that, right? It was 20% down move in a day. How do we avoid that? So this is what it looks like on a daily chart with the relative strength. So beginning of 2023, if you're watching it, this is the 20-day moving average line and the relative strength indicator, right? We get to a top in March. Price comes down to the 20-day, no problem, starts consolidating sideways. The biggest thing is every time RSI comes down to that 50 line, it gets support there, right? So all these little corrections, it comes down basically to the 20-day and the 50 RSI line. When it gets below that 50 RSI line, you start to have bigger problems, okay? Because it's down below that 50 RSI line all through here. Then we get this rally, and we're above the 50 line on all these little pullbacks. On this day, it got below the 50 RSI line, and we had a big reversal candle that closed way below that 20-day moving average line. That was a huge shot across the bow, right? And it was a sell trigger for us. So it would have been, obviously, in hindsight, a great time to sell it. So if you had sold on April 4th, you would have avoided this big move down, and then we had a little consolidation, and then that was that 20% move down in one day this week. So the value of technical analysis for us definitely is the ability to avoid this stuff. Now we're back down at extremely oversold levels, right, on relative strength. It's not saying that you should buy it there, but now it's worth actually watching, because now the value of it increases quite a bit. So now you're watching. Maybe it comes down. Maybe it comes down a lot more. Who knows? But eventually, as it starts turning back up, you're going to see it in RSI. And ideally, we get, RSI turns. This moving average of the RSI comes down. We get across there, and we get some kind of bottoming pattern here, and it breaks to the upside, and that's where you would want to get back in and buy it. And that's where it would be a good value, as opposed to trying to buy it now, where this is called trying to catch a falling knife. Or if you were buying it up here because it's a great company and you want to, hold it for the long term. I can't get away from this sort of trading mentality versus holding things, buying and holding. I just cannot. I can't stomach this.
Yeah. I mean, because we're coming from it from a retirement account perspective, which means we're not willing to take those huge drawdowns in our retirement account.
Right.
I don't know anybody that would want that, right? It's very different if you've got $10 million, working with your wealth advisor, and they have you in a portfolio that you're just trying to maintain wealth for the next 20, 30 years, right? That's why what you hear on, Bloomberg or all these, different financial news outlets are a lot of times speaking to those individuals. Yeah. They're not speaking to those of us with, 500,000, 100,000, $1 million in a retirement account, right? Where you're not going to stomach a 20% loss within, a few days or weeks, right? You're just not, you shouldn't anyway.
Certainly not if you're close to or in retirement.
10 years from retirement. I don't care if I was 20 years from retirement. Right. But more so, you probably wouldn't have that much money in your core account, in the first 5 years. In 15 years, 20 years, yeah, absolutely, right. And so with a normal quote unquote 30-year career in federal service, why would you stomach that, right? And so that's the learning takeaway from that. Other than the fact that what Jerry just showed you, and I'll go back to the chart, is how this works, right? And so education first. This is how you would miss one of those losses, and from a strategic standpoint, right? Why wouldn't you do that, right? And so hopefully you guys are seeing the value of this type of active investing, right? Was that a daily chart or weekly chart? You used
daily.
the week, yeah.
Weekly was first, and then this is daily.
And so even on a weekly basis, you might have missed some of that, right? But it's harder to do it on a weekly basis. Daily basis, that's when you're because this is a volatile stock. That's probably not going to happen that often.
It's not going to happen on the C fund, for
exactly. So I'm trying to put things in perspective. That's probably not going to happen in the C fund. Now, if you're trading this in your IRA, you absolutely could miss that. I mean, you could trade
avoid
it. That's the word I'm looking for.
I mean,
not miss it, but avoid it. Yeah. So yeah, take it for what it's worth.
Okay. Last piece. So kind of what we were talking about before. People getting this idea that one we see all the time, right? CNS 50-50, ride or die, like all that. And if you're looking at this chart, it goes back to the bottom in 2009. Okay, the black line is the S fund, the orange line is the C fund, and the blue line is the I fund. Okay, so if you're looking at this, you're going, why would I ever be in the I fund? That would be the first thing I would look at and go, why would I ever want to be in the I fund? It's obviously outperformed since the bottom in 2009. The S fund, so obviously this is a percentage move, okay, since this point for all of these funds. So the S fund is well above the C fund almost all the time, right? So if you're looking at this, you're going, all right, why would I want to be in anything other than the S fund? Now, even though it's above the C fund almost all the time, as of right now, based on this 2009 starting point, the C fund is quite a bit above the S fund, right? So they oscillate. So when you see these like performance charts, you can cherry pick these things to make it look like, and it's not wrong, it's not untrue. It's just that
it's perspective.
It's perspective, right? Wherever you put your starting point, you are seeing data in a certain way. You just have to be aware of that, right? So this is the really long-term view. This is a shorter-term view. So now we're starting at the top in 2022. Okay, so we're kind of bringing it into a time frame that most people are still got their head around. Here we are at the top in 22. The C fund has pretty clearly outperformed everything. The S fund is still negative, right? It hasn't hit new highs. This is the zero line, right? So the C fund is up roughly 10% from where it was at the top in 2022. The S fund is still down 8% or so from where it was. The I fund is up 2%. So since the top in 2022, you'd have been better off being in the C and the I fund, right, than the S. So it's that perspective from the top in 2022. And then if you really want to kind of zoom in a little bit, I just did this just to show how you can kind of mess with the, not really mess with the numbers because it's true. It's not that it's wrong. It's all perspective. Here we were back at the bottom in October 2022, right? The bottom of that bear market. The I fund absolutely crushed it, right? And still the I fund and the C fund from the bottom in 2022, from the bottom of that bear market, the I and the C have returned basically the same amount, and the S fund has lagged quite a bit. So, and this was a huge move above the C fund. So if you were in the I fund, this was the I fund, 100% I fund would have given you by far the best rate of return from October 22 to May of 23. So all that just to point out that it's all perspective, and don't get sucked into the charts that look like this or any of them, because they're when charts like that get put out, they're trying to paint a picture.
Yeah, to fit their narrative.
To fit their narrative, yeah.
Right. And we really try not to do that. So we get a lot of pressure to put some of this stuff up on our website, and we fight it because I could move the needle left or right a few inches. A few days, right? And it changes the whole narrative if you're just looking at a snapshot in time. And so it's not fair, right? It's not fair to anyone looking at it to say, oh, well, this snapshot in time gives you these. And people want that, though. They just want that hard evidence of something. And it just doesn't work that way. And so before we move on from this, though, I would say, as Jerry went through those charts, if you're thinking to yourself, well, then what's the use, right? If you come at from that direction, like glass half full, well, here's something you can kind of take away from it. So, if you're trying to learn how to use these charts to make decisions going forth, one of the kind of tools you can do, the ways you can use this tool that Jerry just showed you, is you can't guess what's going to happen for a given year. But what you can do is sit down at the end of the year, the beginning of the year, just to have a place to do it. It doesn't really matter what time of the year you do it, but December, January timeframe, right? You sit down each year, you look back at the last year and see what the market has done. You see what has outperformed, right? And try to go a little deeper and see why it outperformed. Then you can extrapolate that, look forward and go, okay, what are the conditions now? What do I think? Because all this is going to be, this isn't necessarily crystal ball. This is trying to find a higher probability solutions, right? And so you're going to make decisions. We think you should make decisions on what the price is actually doing. But there's nothing wrong with setting up a strategic plan for the year and saying to yourself, what are the seasonal implications for this year? Go take a look at the Trader's Almanac, right? What are the what did last year do? Are those conditions the same now? What has changed? Yep. Go look at those factors and say to yourself, okay, plan A is that the CS and I are kind of going to do this for the next 6 months or so. And you're not going to do this in January and ignore it. Right. You're going to need to revisit it, and you're probably going to need to revisit it on a weekly basis if you're really doing this. Because then you'll start to see the trend. You'll say, oh, well, these are not the same conditions, or they are. That's really where you want to get to, is comfort going, okay, looking back, the value is what caused that. Now that you wouldn't know at the time. Mm-hmm. You can extrapolate that into the next year and go, okay, are the conditions the same? Are they different? How's that going to impact them? That's what we do on a weekly basis to you guys. We're telling you all these things, but we don't have time to dive into it that much. Right. But the takeaway from these kind of, what's outperforming what, we have those on our website. You have to be a member to see them, but it shows you clearly at any given time which one of the funds is outperforming the other, mm-hmm. right? Now, you wouldn't want to make your investment decisions just based on that. But if you did know the market conditions are the same as they were in another time, and this is kind of looking the same, your probability levels go up extremely high. And so that's just a way to kind of use these tools rather than use them as a performance tool, right? Go back and go, oh, I won because I was in the I fund.
Right.
Well,
right.
You were lucky. Unless you did it based on the way I just described it, you just were lucky. Now, if you weren't lucky, if that was your plan A and plan A worked, hey, man, we're all clapping for you. Yeah. If your plan B, you get where I'm going. I don't want to beat this to death, but I think it's a great tool to make decisions going forward to help analyze this. It's not a great tool to beat yourself up because you lost or pat yourself on the back if you want.
Right.
Because all you're doing is taking a snapshot in time and saying, "Oh, I'm beating the market."
Yeah, it's meaningless. You want to be on the right side. You generally want to be in the stock funds when the market's moving higher.
It's pretty simple. If that is the one thing you take away from all the talking that we do, what we're trying to get out to the greater public is the best you can do is to be on the right side of the market when it's going up and to be out of the market when it's going down. That sounds simple, and it is not always easy. Yep. Right, but it is very possible to do. You've got to be actively engaged.
Got to be engaged.
Yeah.
All right, that is all I got for the week.
That's not all you got. That's a lot, man.
That was a lot. No, I know. As I was putting that together, I'm like, this is a pretty good one.
Yeah. All right, guys. Hopefully you got some value out of all that. If you have any questions, shoot them to us in the comments section wherever you found the video. If there's no comment section, you can always email support@growmytsp, and they'll get us the the question or comment, and we like getting comments because it helps us put together stuff for other shows. If you want to find out more about how we do all this stuff and you're not a member, go check out the website. All the stuff is there. And the worst you can do for yourself is go download our ebook and get educated that way. It's free. You don't have to join the site to get it. And hope all is well. If you like it, share it with your friends.
Share away.
All right, you guys be safe out there.
Have a good week.